business undercapitalization. So the global macro small and medium-sized enterprise finance gap is estimated at $5.7 trillion, and if you consider informal businesses, it's $8 trillion. And specifically in the developed world, I'm not sure if you can make the same case in the developing world everywhere, but what we're seeing in Europe, in the United States, is that we're seeing a reduction in real terms in access from small businesses to capital. And the two causes that, I think are quite significant are the consolidation of the banking sector. And this is happening not just the commercial banking sector, but across the financial ecosystem. We've been seeing consolidation for the last 30-some years. And what happens in the commercial lending, in bank lending, is that, this is a good example actually. So up until 1980s, in the United States, we have about from 13 to 15,000 of small banks consistently, and then suddenly this number drops aggressively to about, so it was like, I want to say like 14,000 banks, something like that. Right now in the United States, there's just about 4,000 small banks left. At the same time, the number of branches has grown aggressively, and this is connected to the deregulation of the banking sector, and at the same time, regulatory capture. So really big banks get really big. They tell small banks, oh wait, you have to produce these reports. You can't operate without, or rather, they lobby the government to pass regulation that says you're not allowed to operate without these things. And obviously, with the advance of technology and its connection to banking, that is a natural progression, but still this pushes out small banks. And statistically, small banks have shown the best satisfaction rates from small businesses. So when small banks are disappearing, and the evidence to this is in yellow, that's the graph of small business capital allocation. And this is the graph of large business capital allocation. If you consider that for the United States, the population has grown and there has been inflation, then in real terms, this kind of feels like a reduction, doesn't it? And what do businesses do when they don't have access to small bank loans? Well, they're going to lower quality capital options. They're going to online lenders, loan sharks, merchant cash advance, same as loan sharks. And they go to big banks, but the big banks, after they've bought up a bunch of small banks, they're interested in larger portfolios. Underwriting a loan for $1 million is just about the same amount of work as underwriting a loan for $100,000. Are you going to spend your human resources on these smaller loans? No, you won't. And the small businesses are left undercapitalized. There's a slide missing that I wish I had put in here about, it should be in between this and this. And it's about the growth of the peer-to-peer lending, crowdfunding, equity crowdfunding, crowdlending, sometimes debt crowdfunding industries. Now, this industry has been developing since, I want to say, mid-2000s-ish. In the United States, the law allowing for debt crowdfunding came out in 2016. In Europe, it also came out relatively just about the same time. And there was a lot of hope in the industry that this is what would fill that, or at least help somehow make a dent in small business undercapitalization. And equity crowdfunding has done well relatively to venture capital, but small business crowdfunding has not. And the reason that I point to is that, in terms of the good things for crowd lending, really good terms for the SMEs. Your sales improve because your community supports your small business. You know, now you're not only the person owning a small business, but also the people who lend you the money. Now they will always go to your cafe, and that increases sales. The community support. Sometimes small businesses report hiring issues, operational issues. Having a community that backs you up helps with this. And for investors, for retail investors, you know, well, a standard retail investor does not have access to high yield fixed income instruments. You're not going to find 14% interest rate on $100 in the market. Indirect benefits happen, right? So if you live in Belgrade and you invest in a small business in your neighborhood, and you maybe have an apartment in that neighborhood, if that business grows, does well, looks good, that increases the value of your apartment. Small businesses pay taxes to pay for the roads, for the schools, for all the good things that we enjoy in life, and these benefits are not, they're not, unlike large companies, small businesses do pay taxes. So the benefits for investors are also indirect, and also being a part of a community, feeling like you belong and you kind of contribute to a community is super important for a lot of retail investors. But the problem is, neither small businesses nor the investors know about this instrument in most cases. Small businesses are deeply terrified of doing this because, you're opening yourself up to strangers essentially. You're telling everyone about what's going on in your company. For many, this is a new experience and they're not ready for this. Paired with the complexity of the process, because an investment crowdfunding campaign is an omni-channel conversion investment marketing raise. A mom and pop shop is not an expert in this. This is operationally, even if they know and have the skills how to do this, operationally executing this is impossible for most small businesses. And paying for people like me, I worked as a crowdfunding consultant in that space for a bit, they can't afford it. Even American small businesses, when I live in Turkey or in Serbia, they still can't afford my services, and it's a very labor-intensive process. Everyone in the industry reports this. And I know this because I serve on the board of directors of crowdfunding professional associations in the United States and worked in that industry for a bit. So cost and time and capital, and very uncertain ROI. So you're going to start a raise, you're going to spend all this money, all this effort, and you might not be able to raise the money from your community that you need, in part because the communities in which the businesses want to raise often don't have the capital that they need, right? Like, if people are living paycheck to paycheck, they might not have, even $100 sitting around to invest in somebody's small business, no matter how much they want. These are liquid investments. This is high financial risk because if you invest in one individual business, you're non-diversified. Thank you, ETF people. Again, lack of awareness. And so the outcome is that investment crowdfunding in the United States, probably one of the most developed markets in this space, is completely statistically insignificant. 10.33 million small businesses in the United States, 10.2 million applied for any form of loan, any form of credit in 2022. 7.1 million got rejected or not fully approved. 313 businesses submitted the filing paperwork with the SEC in the same year. Not 313,000, just 313 businesses, right? 0.003%. So it's completely irrelevant relative to all of them, all of the businesses who wanted to receive the capital and everyone who wanted to receive it but didn't apply. So the question is, well, if investment crowdfunding is good, if it helps small businesses achieve the capital that they need, the funding portals thought that starting a funding portal solo and then going to small businesses, marketing them the service, and then helping them reach investors, they thought that this would work, but it didn't. And if we think that the problem is real and it needs solutions now, well, one of the things that we conceptualized here is there could be a model in which there is a matching funds mechanisms where the small businesses community functions as the due diligence tool for the banks. And if like, let's say, this is completely arbitrary number, right? So if say 50% of the goal is raised by the community, then the rest of the goal might be auto-invested by the bank. Obviously, there is very high risk, kind of like, the bank takes on a lot of the risk in the process here, but still, this is a way to reduce the interest rates because community investment decreases the risks of non-payment. And this is also an opportunity for the bank to get checks, not only to basically earn money, not only on the success fee of the raise itself. So the way that we envision this is this. Within a commercial lending group, you have an SME lending arm. Within that, SME banking arm, right? Within that, you have your business lending. Within the same portal where your loan, the standard loan tools are offered, the business owner can be presented like a box that says, hey, do you want to do a crowdfunding raise? The small business solicits investments from their community and from people that might have brokerage accounts with the same bank. If they solicit, all of these people do make a decision to invest, and that reaches 50% of the target goal, then the bank auto-invests the rest, and they might invest a part of that sum from their own kind of their own capital. They might also offer that as an opportunity for institutional investors that they have with themselves. So that's another kind of element of where the fees might come from. Take this with like a pound of salt, because this is just an early kind of development model. But these are the benefits that we've outlined here for different stakeholders in this process. Banks get additional revenue streams. They get opportunities to cross-sell their services to both SMEs and investors. They have improved customer engagement and brand positioning, because now you're looking like a very modern institution. You're doing some fintech stuff, community investing. The risks for non-payment on the loans is mitigated by small businesses taking the loan not only from the bank but also from mother, father, sister, brother. You want to pay back people in your community, otherwise risk not being welcomed at the dinner party. And finally, this does help with UN SDG goals on poverty, reduction of unemployment, hunger, access to good jobs, etc. For small businesses, this is still high quality capital, and it's more affordable because we assume that interest rates might get lower. Reduced risk of campaign failure, because now it's not just your community that has to put up the money; it's also the rest of it's the bank itself. So you might actually raise the full amount that you need. The fundraising process is simplified because now the bank can help you reach the retail investors. And then, community protection in case of closure, in case of default, a bank will foreclose you, the community might not, right? They will find ways to keep you alive because it's strategically important for members of the community that you stay alive. And for investors, this offers opportunities for again, high yield deals. The higher chance of the business receiving the full amount that they need also helps the investor because it increases the chance that the business will survive. This is convenient and trusted investment infrastructure because now the investor doesn't have to go on some shady third-party portal, but it's within the regulated bank. And for institutional investors, it also gives them the ability to auto-invest millions of dollars into SMEs, right? If the bank has an agreement for auto-investing with institutional investors, with some pension funds, for example, in the same way that like an ETF works, right? Institutional investor can allocate $10 million and say, if a business reaches this benchmark and if they are from this municipality, if they are, the spouses of people working for the auto industry, the auto pension fund might set up something like this. So they can target creating values for specific communities. There are examples of this. They are structured differently. That's why I showed the model earlier and just want to quickly run you through these two options. How am I doing on time?
Okay, you are out of the time, but you have time.
Okay, I'll try to be quick. I'm sorry.
You can reach the final conclusion.
Yeah, I'm on the final stretch. So there are two examples that I found that I wanted to show you. One is Triodos Bank from the Netherlands. They have two options for it's a standard bank that has a crowdlending portal within them. They're not doing all the fancy like risk diversification, bundling, investments and stuff. They're doing direct investments. You can invest directly through their portal, through your bank portal, into crowdlending deals that they have available. And they also have a tool that allows for direct investments with some tax benefits, called IFISA. And then the Psshka bank, the Russian bank, did something very interesting. I spoke to their product manager that is responsible for this product. They're doing aggregated loans, so they're diversifying the risk by bundling these SME loans. These are generally shorter term loans, so they're not, I was usually looking at 3 2-year loans. They're doing 3 to 6 month loans, aggregated programs. They have a very, very robust filtering process, so they're very careful about who they're taking on. They do compensate investors on failed loans, I think about up to 5% of the investment, of the principal. And they also do loan factoring deals, so the factor investments. So you can put in the money that you will get out based on supply chain contracts that already exist. That if like a firm is getting paid in 90 days, but they need the capital now, they're making these investments through kind of a crowd lending portal that they built. Where we're moving this towards basically surveying experts in the banking industry, people generally working inside of commercial banks, and in order to really drill down on what this model could look like for different banking institutions, we want to ask them basically, launch a survey on whether they see crowd lending, and generally SMB focus as something that they're strategically interested in, where they see opportunities for revenue impact, where the risks and kind of difficulties might be in terms of technological integration and integration with other business partners that they have, risk considerations and regulatory considerations, and finally, where the market is going for, in generally for the banking sector within their countries of operation. Also, we're asking industry experts from the crowdfunding space, both in the United States and Europe, how they see it. And the implications, the results are, limited yet, quite now. But we're in very early stage and hope to research this further. But right now, the implication is if we can increase small business capital access, that's good. If this model is viable, then it can be integrated in different countries. So this can have an impact internationally. If we can, if business capital access increases, hopefully local communities become more self-reliant, independent, financially stable. Over the years of looking into this, I found appreciation for small traditional banks. So if something like this can be built for small banks, then hopefully the quality of credit issued will also continue improving. We're going to keep researching this. Thank you very much. Sorry about that.
Okay, thank you.